In this video, I want to explain to you the differences between a deferred tax liability and a deferred tax asset, show you how to calculate those and also how to report them. So let's start with that deferred tax liability. This deferred tax liability occurs when a company defers a tax payment. So remember, they're just deferring a tax payment. And basically, it's created when the profit on an income statement is more than the profit on a tax statement. So you can say your profit on your income statement is greater than or more than the profit on your tax statement. So how can this happen? Well, there are some differences between your profit on your accounting records on your income statement and your profit on your tax statement. An example of a deferred tax liability that you're going to see a lot is the difference in depreciation. Maybe a company uses straight line method for their accounting purposes, but then like an accelerated method for their tax purposes, which is totally fine. They can do that, and that creates a different income. So what happens here is we're going to take our taxable income we multiply that by whatever our tax rate is, and this is what's going to equal your income tax payable. What you actually have to pay based on your taxes. Then we have our accounting income. We'll multiply that by our tax rate, and this is going to equal your income tax expense, or what actually shows on your income statement. The difference that this creates between these two, if there is one, sometimes there's not, but if there is a difference, that's your deferred tax liability. So let's see what that looks like in a journal entry form. We're going to debit that income tax expense. This is a debit. And then we're going to credit our income tax payable. And also credit that deferred tax liability. It's also a credit. So that's your deferred tax liability. Basically, again, you're saying, I'm going to be paying these taxes later. So what then is a deferred tax asset? A deferred tax asset is kind of the opposite. It occurs when a company pays taxes in advance. So this occurs, it's when the profit on your tax statement is more than your profit on your income statement. So your profit on your tax statement is greater than your profit on your income statement. And again, this does occur it's normal. A good example of a deferred tax asset is when a company has a loss carry forward. This loss is an asset or a deferred tax asset because it's basically offsetting the profits in future years, therefore creating an asset. So how do we account for that deferred tax asset? We're going to take the deductible temporary difference, and these are all for temporary differences. We're going to multiply that by our tax rate, and that's going to equal our deferred tax asset. The journal entry that we would need to record that deferred tax asset is going to, again, be the debit to your income tax expense. We're also going to debit this deferred tax asset. And then our credit will be to that income tax payable. Where does all of these accounts go? The deferred tax asset, deferred tax liability. These are shown on the non-current section of your balance sheet. Now, we will offset to see whether we have a deferred tax asset or deferred tax liability to show, and we'll show you that in the homework problem that we're going to do. So let's go ahead and walk through one of these homework problems that shows you the deferred tax asset and deferred tax liability, puts it in a journal entry, and then asks you to also show it in your balance sheet. So, again, a lot of words, take it piece by piece. And the first thing we want to do is prepare that journal entry to record the income tax expense, those deferrals, and the payable. So I can start by reading through and seeing that where we have a litigation liability, it's settled in 2020, which is the following year. This liability is going to create a deferred tax asset. And then we have a difference in the accounts receivable of $50,000. This represents future taxable amounts. Because it's going to be future taxable amounts, as it says right here, that's going to create a deferred tax liability. So how do we calculate that? What does it look like in a journal entry? And then finally, how is it presented? So, first thing we have to do is we can calculate our income tax payable. That's an easy place to start. We know our income is $350,000. Our tax rate is 34%. Which means our income tax payable is $119,000. I can start, I know what these journal entries are looking like. We can start filling in those numbers if we want to, or at least get in the journal entry so that I know which pieces I need to find. So we know we're going to debit an income tax expense. We know we're going to debit a deferred tax asset. Because we already figured out we have that. We're going to credit that deferred tax liability. We already figured out we have that. And we'll also debit that income tax payable. So maybe I should have done that part first, since I know that those accounts are going to get hit. Then I can go through and kind of put in the numbers that I need. So I just figured out this 119. And I can put that by my income tax payable. All right, what's next? Next, we're going to go through and look at our different pieces of the puzzle. Let's look at the income tax. Which one should we do that? We'll go with the liability first. The liability, we have our $50,000. That is based on the 34% tax rate, which equals $17,000. Now we can look and see at the beginning of the year there was nothing recorded, so we don't need to offset that by anything. So our income tax, or our deferred tax liability, is going to be $17,000. Now we'll go ahead and do that same thing for our deferred tax asset. Our deferred tax asset is $30,000. We have that tax rate, and we're going to multiply that out and get $10,200. I'll go ahead and I'll put that in my journal entry. And then what I need to do is just kind of plug in to find out, well, what is my income tax expense? So this would be the last piece you're going to fill in. Debits have to equal your credits. So I know that my income tax expense should be $125,800. Again, we can look at that saying I have the 17,000, the 10,200, and I also have the 119. So to get that plug-in figure, I would just add these up and know I need $125,800. The second piece of this is, how is it presented on the balance sheet? We know this is presented as a non-current, in the non-current section of the balance sheet, but we have to show which section it's going to be in. Now, because my liabilities are greater than my assets, I'm going to show it in my as a deferred tax liability. And these are going to offset. So I'll just add up these two numbers here to get to the $6,800 difference. And that's the amount that I would show in my balance sheet. Let's walk through what this looks like in a homework problem, or how these homework problems translate into test questions. So once again, might be a great time to stop the video, take a break, see if you understand the material, by trying these multiple choice questions, and then coming back to see if you got them right or not. So let's go ahead and try one of these out. So this first problem is a calculation, and their companies using straight line depreciation for income statement, but using an accelerated method for tax purposes. Again, we can do that, but it's going to create this difference. So the difference that comes through is in the depreciation, which affects our expenses. So they want to know that what should be reflected on the balance sheet. And the balance sheet's going to take into consideration that ending balance figure. So what we want to do is look at the difference it created in the years, take that difference, multiply it by our tax rate, which would show me what that balance sheet is going to say today. Right now there's a $70,000 difference, which would be C. And just as a reminder, this shows up as a non-current in that non-current section. So some of them are as simple as that. And I wanted to go through with you one of these that are just words, no calculations. In this class, we tend to focus on those calculations because they're a little bit more difficult and time-consuming. But sometimes it's these simple word questions that kind of throw us. We probably think that they're harder than they are, or we're just not quite sure what they're asking. So this one is saying if expenses are recognized on the income statement before they are recognized on a tax statement, what would this create? So we know it's going to create either a tax asset or a liability. So first thing I would do is kind of cross out these last two. Don't let them mess with your mind. And usually if you see the word only or something like that, it's kind of a trigger that really be careful if you're going to pick that question or that answer. So this one is saying that my expenses are higher on my income statement than they are on my tax statement. So if my expenses are higher, it's going to be the profit on my tax statement. Well, first of all, let's go back up and review. Here. These are the things we want to review. The profit on my income statement is greater than the profit on my tax statement. Then we have a deferred tax liability. If the profit on my tax statement is greater than the profit on my income statement, that's going to create a deferred tax asset. So we have to get those thoughts in our head. We'll think that through. Maybe we memorize those two little equations to know which is which. And then we can come down to the question and apply that to see which one it fits. Here, if we have the expenses are recognized on the income statement, that means my tax statement, my profit is going to be higher. And my income statement, my profit would be lower. Which means I have a deferred tax asset based on our original up here. If my profit on my tax statement is more, than the profit on my income statement. It's a deferred tax asset. So again, maybe make sure you have that in your notes. Get those two differences straight, because sometimes when we see them in a simple word question, it's hard to recognize which one they're going with. As always, let me know if you need help with any of the other homework. Make sure you try some additional homework that's not graded, just for that practice, especially in those areas that you're not confident.